CPI is on the rise, which means inflation is on the rise. Yet the market brushed it off like it was nothing, with the S&P 500 rallying 1%, leaving most participants scratching their heads and asking the question, what gives? So today, we're going to be breaking down why the market did what it did, and we're also going to be looking at the consumer. The reason why this economy is so resilient is in large part to the average consumer, and today we're going to be breaking down why. So with the S&P 500 closing at another all-time high, it seems bad news is good news, and good news is great news. So let me help you bring some logic back into the market, and let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment. It really helps me with the algo. Cheers. Today was a throwback to 2023. We had the mega caps, Microsoft, Nvidia, Amazon leading the way, Meta as well. Then we had software application in close second. But we also had the big names in the other sectors perform. Look at Visa, JP Morgan, MasterCard, Home Depot, Costco, Walmart, Eli Lilly, right? These names performing the best, outperforming, leading the market higher. But we also got a bit of outperformance here in software application, industrials too, except for aerospace. Boeing going through the ringer at the moment. Financials actually did pretty well. The only red sectors that we really got was like utilities, real estate, energy, and then this section here in comm services. Now, for those of you that don't know, this section right here, it's actually a defensive sector, by the way. It's part of the SHUT index. So it's staples, healthcare, utilities, telecom services. So if you see this green while the rest of the market is red, it's actually a defensive rotation. A lot of people don't know that. But looking at the actual sector heat map, complete outperformance here in technology. Look at semiconductors, software, tech, and then home builders. They all beat the SPY. The worst performing sectors, GDX, metals mining, right? Utilities, and XLRE. But let's just look at this realistically. Real estate and GDX have been one of the best performing sectors this month. I think they were just giving some of the gains back today. And then metals and mining were just in the dumps. They're very volatile as well. And then we had energy down 0.18%. And then materials were pretty much flat. So all in all, a very good day. If you're invested in a sector, they return 0.5% for the day, 0.42% for the day here in industrials, financials, healthcare, staples. You take those gains. You take those gains and run with it. Any gain you do get from the market, you take it, you run with it, and you call it a day. Now, in light of all of this, the market actually rallied on hot CPI. You see CPI came in at 0.4%. The consensus was actually 0.4%, but core CPI came in at 0.4. Consensus was 0.3. And then on a year over year figure, it came in at 3.2%. Consensus was 3.1. And then core CPI 3.8. Consensus was 3.7. But this number right here, okay, wasn't actually 0.4. It was actually 0.36. So it wasn't the hot 0.4. And a lot of these are actually rounded up. And I'll tell you why inflation wasn't as hot as you would have thought. It actually came in a lot cooler than you think. This is why the market rallied. So number one, higher gasoline prices add 15 basis points to the headline CPI. It's extremely volatile and can add 15 basis points or subtract 15 basis points the following month. Transportation services added 13 basis points and auto insurance added 6 basis points of that. Used cars and trucks added another 5 basis points, right? So used cars and trucks, 5 basis points. Auto insurance, 6 basis points. That's how we get that number. Without these components, month over month would be 0.29%, right? They'd round it up to 0.3. And then year over year would be 2.9%. And this doesn't even include shelter. So like you don't even remove shelter from the mix. You just move gas prices, right? And then transportation services, used cars, auto insurance. You remove those three figures and you get a very, very cool inflation print. And that's why the market rallied. This data right here is really going to make the Fed think about what to do next. It's going to be very hard for them to decide when rate cuts are going to come. Is it going to be May, June, or July? Tough outing for the Fed next week. But I think in FOMC next week, we really have to pay close attention to what Jerome Powell is going to say and his commentary on this. But let's hop on the charts. Now guys, this is the S&P 500, but before we get into the charts, let's actually have a look at what indices did on the day. So the S&P 500, NASDAQ, all up in excess of 1%, 1.2% here for the SPX, 1.49% for the NASDAQ, 0.26% for the RSP, up 0.03% in after hours. So pretty good gain right there. Mid caps up as well. Small caps took it on the chin as well as the IWM. Bond yields actually rose on the day, and that saw bond prices as a whole fall. overall. Bitcoin and gold were down about 1%, 1.73%, and then the dollar and oil were largely unchanged, although slightly in the positive. And having a look here at Bitcoin, this momentum is definitely slowing, as you can see. Looking at the daily chart, we can see that we're still getting these pretty volatile, these pretty big candles right here at the top, but putting out red days, but buyers definitely buying the dip. You could see like all the way up here, buyers coming in at the lows, pretty long lower wicks, pretty short upper wicks, while the price just grinds higher. That definitely means there's bullish momentum in the charts, but we really have to see what this means because we are getting quite a lot of red candles. Very similar structure to what you see on the way up right here. You kind of go get some red candles, consolidate, and then you go higher. So if Bitcoin does consolidate here, for the next maybe 5 to 10 trading days, don't be surprised. But let's actually go ahead, look at the S&P 500. We're going to start here on the weekly chart, guys. Now, first things first, zooming in on this weekly chart. Now, I know the week's not closed, but on a weekly closing basis, if we were to end the week right now, we would close at a new all-time weekly high. But hopping on the daily, right? This is the daily chart right here. These are the two levels we outlined in yesterday's video. First things first, we actually closed at a daily all-time high. The wick did get higher, but on a closing basis, we've actually never closed higher in the S&P 500. That's very, very bullish. Something you do want to look at is actually the closing level. It is far more important than what we did intraday because this tells us where sentiment is sitting overnight. Now, buyers did come in at the lows after that CPI print very, very aggressively, and we actually moved ourselves to the upper 1/3 of this green candle. Very bullish candle, closing pretty much at the highs. This is a bullish candle right here, and I probably expect this bullish momentum to continue into Asia trade, into Europe trade tomorrow. Now, we could see that we actually formed an equal low right here, a slightly lower low, but inconsequential, and really this was really the low we were looking to take out. Bulls couldn't do that, and we actually bought the dip and made our way all the way up. At the same time, guys, we actually zoom out right here. We're just making higher lows, as you can see, all the way up, and even right here right now, and then making higher highs at the exact same time. This trend is literally going from the bottom left of the screen to the top right. That is a bullish trend, and you don't want to fight the bull, and you just want to buy dips at strategic locations. Now, looking for the rest of the week, what are the bears going to have to do? You're going to have to really push to this 50 level and close below. That's what you have to do. Bulls right here, right now, I think for the rest of the week, if you can get a close above this wick, that is going to be insanely bullish. If you can get a close, at this 5,200 or just below the 5,200, that's what bulls really want to do. But ultimately, I think bulls want to probably stay above the open price of this green candle right here. But hopping on the 5-minute chart, let's actually have a look at intraday trade. So yeah, we gapped up here, had a bit of volatility in the early morning, and then bears came in, bought the dip right here all the way up. Sellers did take us lower, but forming a higher low, we then actually went and broke the high, closing at an all-time high. And actually, it was really just this red candle right here, the last 5 minutes of trade, that took us lower and caused the wick here on the daily chart virtually inconsequential. And when you really zoom out, that wick is right there. You see that wick? It doesn't really matter. So all in all, this chart looks bullish. S&P 500 looks bullish. I mean, you look at the NASDAQ, this level right here, 17,836, let's call it 17,840, acting as a very, very strong support zone, forming sort of like a correction in time here in the NASDAQ 100. And the RSP as well, grinding higher. This right here, this is just like a slow grind higher. So very bullish price action when you actually zoom out on all of these indices, especially the S&P 500 with that all-time closing daily high. Now guys, just a really quick announcement, something I thought I'd do. We'll see how it goes for the next month or two. If it works, it works. If you guys seem to like it, we'll keep it around. But essentially, I'm going to be creating a public portfolio with all the income I receive from YouTube and X. Now, it's not a lot of money, and just thought I'd build a portfolio, be completely transparent with you guys, show you all my buys and sells, as the day goes on. It's not going to be a trading portfolio. It's more of a buy and hold type of portfolio. I'm going to stick to the same investment strategy I normally have, and that's, discounting future cash flows, finding undervalued plays with good businesses, and growing earnings upward of 15% every single year. So I got one holding right now. It's Google. I've finally taken a position in the stock. We have $454, 3.3 shares. We're slightly down on the portfolio currently, and I think Google fits the bill. Now, ideally, because the value of the portfolio is so small, small. You'd think you want to get into like smaller cap names, momentum names to really grow this, but that's not really my style of investing, and I just thought I'd stick to what I know. Even though it is a small portfolio, we could still track the return. That's perfectly okay. And really, this is all that matters. The only difference between this and a huge portfolio is just the dollar figure, really. But yeah, we have one stock in there right now, and I think Google fits the bill. But we won't dive into the fundamentals of Google today. Follow me below, hit that subscribe button, guys, and I'll do a full fundamental analysis on Google in the weekend video. Now, guys, the reason why stocks are rallying, especially in these last 3 to 4 months since October, has to do with earnings and the economy. Both are much better than expected. This is the current S&P 500 earnings scorecard. We're looking at earnings growth of 10%, double-digit growth, 13.6% excluding energy. 496 companies have reported, so this is a pretty good figure as to what we're going to do, and it might even go higher on Oracle's earnings and Adobe. We'll have to see what Adobe does because they are a big player. They do contribute a lot to earnings per share in the S&P 500. But on a revenue level, we're looking at 3.7% in the S&P 500, 5.1% excluding energy. This is great earnings because, a year ago, people were expecting Q4 2023 earnings to be negative 2 to 3%. It's now 10%. That is absolutely insane. And we got some Goldman Sachs commentary on this earnings season, so let's go ahead and read it. So they say, revenues higher, but CapEx growth and hiring to remain lackluster. Now I'm just going to read these 4 points right here. It's just what they've deduced from this earnings season. And number one, lower interest rates and easier lending conditions are likely to produce a surge in CapEx this year. We can also add to that the AI cycle is making tech firms really invest heavily, and that's increasing CapEx this year. Staffing levels and labor shortages have broadly returned to pre-pandemic levels. Hiring freezes are becoming less common, but gross hiring is unlikely to rebound significantly. Wage pressures continue to ease but have not dissipated. And essentially what all of this is telling me, what this earnings season is telling us, guys, is that there's a huge CapEx cycle coming, and we're returning to the pre-pandemic trend of labor, wages, hiring, staffing, interest rates, lending conditions, and that's really what we want to see in the economy. Everything was inflated because we injected $1.7 trillion into the economy, and to go back to pre-pandemic conditions is not necessarily a bad thing. Now, looking at earnings revisions, what is to be expected? So this is for 2024 earnings revisions, and we could see here we got the US, Europe, Japan, and then emerging markets as a whole, and Japan's earnings are absolutely skyrocketing, and I think this has to do with how strong the economy is. And we also know that's the case because the Bank of Japan is thinking of normalizing their negative interest rate policy. We're also seeing that Europe and S&P 500 roughly doing the same in terms of earnings revisions. I mean, Europe did have a huge spike up. Those earnings have not materialized, and we have seen significant downward revisions from an open to close basis. It's roughly the same as to what the S&P 500 is doing. The US has actually seen sort of earnings tick up ever so slightly in the last 6 to 8 weeks, and then emerging markets, well, it's been an absolute dumpster fire for earnings revisions. Still earnings growth for the most part, and we are actually forming a bottom right here and here. Maybe we do see upward revisions from here. I mean, once you've hit the bottom, there's nowhere to go but up. Now, the reason why earnings is so good has to do with the consumer, and not just in the US, around the world, but particularly in the US, the hiking cycle has yet materially to affect households. We could see here that debt service ratio and financial obligation ratio are still at historically low levels if you look at history as a whole, and are still near the pre-pandemic levels, as you can see on these charts. And that's why the consumer has really held in there, because their debt service ratio and their financial obligation ratio are about the same at the same time that their incomes are actually increasing, especially in the lower and middle incomes households. Their after-tax income appears to be growing steadily. You can see here that incomes 50K and then 50K to 125,000 have actually been on the up and up, while incomes 125K and above have sort of been stagnant for most of 2023, 2024. And this is a really, really good thing. And this is why sentiment is on the up and up. We can see there's been a bigger rebound in sentiment among the top thirds of households by income. This is based on the Michigan Consumer Sentiment Income by Tercile. And we can see this huge rebound in sentiment is simply because households are paying the same amount of interest and have the same financial obligation as they did in 2020, but they're just making more money. That means they have more disposable income, and that's why sentiment is on the up and up. And we're starting to see the sentiment show up in the spending data. We got the MasterCard Spending Pulse survey, the insights for February 2024, and following a solid holiday season, weather did impact January sales. However, consumer spending was resilient in February, and that helped retail sales increase year over year, and online retail sales were up 9.1%. The apparel sector was up 14.5%, and the restaurant sector was up 6% And we also did have Valentine's Day in February as well. And the only way that this here can happen is if people have more disposable income to spend on their wants, they're paying less debt, and consumers relative to their income are less leveraged, they're paying less debt. And that is why we're seeing discretionary spend increase year over year, in some instances in the double-digit region. Now let's switch gears and actually talk about market structure. Very interesting chart I found. Now this is market tops versus market bottoms, median market bottoms versus median market tops. And you can see here that when a market bottoms, it happens very, very quickly. It's about 75 days from the start of the drawdown to hitting the bottom and then rebounding 20%. And that's why when you see these market bottoms, you need to react quickly and you need to react fiercely, and you have to have conviction in what you're buying, and you have to have a little bit of patience as well as stomach some of the volatility, because this period right here, it's intense and it can whip you out. However, if you just hold and just don't look at your portfolio, you buy the dip, you will thank yourself in the long run. However, market tops are not quite like that. Market tops actually take anywhere from 300 to 600 days to materialize, and that's simply because of the way the markets are geared to be bullish. Now let's talk about gamma. Now we got some interesting changes here in the gamma chart, the GEX chart. Firstly, this 5200 strike keeps getting built out. It's very big relative to the rest of the gamma level. Secondly, the high volume node or the gamma flip zone has actually moved from 5,000 up to 570. That means one of two things is happening. Either more negative gammas coming into the tape, or we've actually lost some positive gamma. I'm going to say more negative gamma has come into the tape. That actually pushes the gamma flip zone higher. Now also, this zone right here, which yesterday was this entire zone, this dense zone where we have both negative and positive gamma, is now very, very tight. And that means one thing. Yesterday, the zone was quite large. It was encapsulating this entire area, which means if we got here, we would have had like pretty volatile trade, but still a lot of positive gamma. If we do get into this zone, there's going to be dense trading action. But if we do get below the gamma flip, we are actually going to sell off quite significantly to this gamma strike right here. So 5070 is a very key zone to watch for the rest of the week, especially as we go into retail sales and PPI. If we get hot numbers or the numbers miss, you really want to watch this 5070 level. So we're going to find support right above the 5000 strike here with this node being built up right there, because that is a positive gamma node and the largest on the tape. It will support price if we do get there. So right above 5000 is a good support level, 570 is a good support level, and then the 5100 area is a good support level. If we do get below this 570, do expect a vicious sell-off to occur. However, we are still in positive gamma. 5200 is the core gamma resistance, and as it stands right now, buy all dips, looking for the way up to 5200 on the way to the monthly OPEX on Friday. Now looking at seasonality, guys, this is crazy. So the current bull market gains are not outsized relative to history. This is the average bull market in the first 2 years and the current. So this is where we are right now. This is the average, and this is every single bull market since. So, you know, on the up and up year, we probably see the bull market of 87, the bull market of 99, the tech bubble, and then this will be like the average bull market. You're probably looking at stuff like 2013 to 2020, and where we are right now, we're generally underperforming the average bull market. So if we do see further gains in this bull market, don't be surprised. Now, I will say though, at this point right here, valuations are a bit elevated. You know, we have the S&P 500 trading at 20x, 21 times, the NASDAQ trading at 26 forward. It's just a bit pricey on an index level. Now, looking at the NDR composite cycle for 2024, very interesting chart right here. Now, what we normally can expect in 2024 is sort of choppiness, pretty much from mid-January all the way to like this May-June period right here, where we normally form a bottom. We actually sometimes go ahead and take out the lows of the year, but normally it actually is an equal low where we have pretty much returned zero for the year into May, and then we go on a blockbuster rally with a little bit of volatility here in September, October, and then we have the turn of the year, end of the year run. People often call it the Santa rally. So if we do see a drawdown that wipes out all of this year's gains, well within seasonality. If we do go ahead and chop around for the next 2 to 3 months, well within seasonality. Just remember to buy the dip and look at the big picture. Now let's have a look look at some BOFA institutional charts. Now guys, we are going to look at market breadth. This is percentage of stocks above the 50-day moving average and the 200-day moving average. And we have S&P 500, 400, 600 here. So we've got a huge basket of large caps, mid caps, small cap stocks. Now I just want to preface this. When you look at this chart, what is a strong trend is when 60% of stocks or more are above these averages. Second, you get 60% or more above. That's an extremely strong market, great breadth in the market. And you could definitely say that more stocks are not just trending, but trending for the long term. Let's look at S&P 500. Look at this, 78.9%, 79%, let's call it that. 75, 73 above the 50-day, above the 200-day, 79.5, pretty much 80% of stocks above the 200 moving day average. And you do know that most of these stocks, right, are large cap stocks. The mega cap stocks, the ones that really move the market, Nvidia, Amazon, Meta. And we could see that last 10 trading days, 2 weeks worth of trade, pretty much one-way traffic, 70% and above stocks above the 200-day moving average. The exact same thing here with the S&P 400. Small caps, it's a bit more dispersed. Stocks above the 50-day, not quite as strong, still 50% here, 45%, 45.3% here. So it teeters above 50%, below 50%. However, percentage of stocks above the 200-day moving average for the last 10 trading days, every single day is above the 60% region. So the long-term trend looking very strong here for small caps. However, the medium-term trend not looking that great on certain days. There's a lot of work to be done in the Russell 2000. So long-term uptrend here. So in the small caps, long-term uptrend, but a bit of volatility coming into the market. This is what this is telling us. But that being said, the big boys, mid caps, large caps, they're really leading the market and showing exceptional breadth despite the volatility we've seen in the market since Friday, since Nvidia put out that very red day. This is the Bloomberg US Corporate High Yield Average Option Adjusted Spread, the OAS. It remains bullish with the new cycle low at 3.05 in late February. This credit spread has seen even lower levels in July 2021, May 2007, March 2005, September 1997. So a continued narrowing of the high yield OAS is not out the question. And generally speaking, corporate credit spreads are low. That's why this is moving lower, and we can actually go lower and hit some of these very low levels we saw in the past. That's a really good thing. That's a really bullish thing. If we are going to see volatility on the horizon, we want to see credit spreads do something like this. We want to see them widen significantly. For the most part, they're not. They're narrowing. That's bullish. The Chicago Fed National Financial Conditions Index confirmed the SPX cyclical bull market from October 2022 into late Jan 24. Since then, financial conditions have deteriorated as the SPX has continued to make new all-time highs. This is a potential bearish divergence for US equities. So you can see here that the index has actually moved lower. It is inverted. Just remember that. As the index has moved lower, the S&P 500 has gone up. That is a divergence. And normally what would happen is a little bit of a pullback. So if we do see the S&P 500 pull back a little bit to match this, not out the question, but this is a divergence that we do need to be aware of. Now looking at the AA US investor sentiment, bullish readings all aboard. We're particularly getting bullish readings well above the 40 region for a consistent period of time since mid to early December, and we've actually seen a persistently more bullish tone since late 2023. And essentially in a bull market you want bullish sentiment, and that's exactly what we're seeing, confirming the bull market. Now looking at the S&P 500 and 10-day moving average of 52-week highs minus 52-week lows, and you can see here that essentially if this chart is going up, it means new highs are beating new lows. If this chart's going down, it means stocks are making new lows relative to new highs. And we can see this is a bullish breakout at the same time that the S&P 500 is breaking out. It's exactly what you want to see, and this confirms this. Looking at more S&P 500 charts, this is the advanced decline line. Very similar situation. Stocks advancing then declining against the index in aggregate. And as this has gone up, which is what you want to see, the S&P 500 has gone up. So they're moving in tandem. There is no divergence, and for the most part this confirms the bullish tone of the market, as well as the broadening out nature of the market. Now looking at cumulative net up volume against the S&P 500, very similar situation. You want to see this chart going up as the S&P 500 goes up. The S&P 500 has been moving up, and this confirms this. Now looking at the S&P 500 weekly chart with moving averages, you can see that we're sort of getting very close to the lower end of this measured move. We form this cup and handle, a measured move from the bottom to the break breakout right here takes us to 5,200 on the low end, 5,600 on the high end. Not to say we're going to hit it in the next 6, 3 or 12 months, but more of a longer term trend to get to this 5,600 area. And we could definitely pull back all the way to 48.19, 47.93 and still be technically bullish and go up and hit this 5,600 again. Longer term charts, this is a weekly chart. We're not looking at the daily or the hourly. It's a much longer term, years versus weeks or months. Now looking at the US 2-year inflation swap rate, we formed this head and shoulders right here. We've broken out above the 50% line and we've actually moved all the way up to this trend line where we've used as resistance, it's rejected, and this key trend line is being tested as oscillators turn down to signal a peak and mean reversion of trend. As you can see, the oscillators right here and here. What does that mean? Probably means we get lower inflation, and some of the inflation numbers we saw in December, in January, some of those hot numbers may just be because of the seasonal period, and we should see lower inflation for the rest of 2024. Now looking at the Bloomberg Commodities Index on the top right here, then we got Brent in the middle, and then we got copper here at the bottom. BCOM double bottom formed in February and broke higher after. This may be a leading indicator that oil and copper could break higher soon. So the commodity index broke higher. We haven't seen the same price action in oil or copper, and this could mean that copper and oil could break higher. Now looking at data, guys, so in the week ahead, we still have retail sales coming up. We have PPI as well. Those are the big ones. Then we also have consumer sentiment, industrial production, and today we got the CPI. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, guys, and leave a comment. It really helps me with the algorithm. Cheers.